My name is Andrew Swary. I'm Executive Vice President and General Counsel at Ohio Community Development Finance Fund. We're a nonprofit CDE based out of Columbus, Ohio. I'm joined today by Carol Mihalic, who's a partner at Kutak in Denver, Colorado, and Jennifer Simmons is a partner at Dentons in St. Louis, Missouri. Maybe I'll just take a second and let Carol or Jennifer introduce yourselves a little bit more.
Hi, Carol Mihalic, partner at Kutak. I'm a tax attorney who practices in new markets and all the other tax credits except for LIHTC. With respect to new markets, I have been involved in new markets since inception. So we've seen how it's changed through the years, as well as just even the last year, the changes through the pandemic. So I look forward to spending the next hour with you.
Hi, I'm Jennifer Simmons from Dentons, the St. Louis office, and I've been practicing in the new market space for about 15, 16 years now, mostly representing CDEs and investors, but also have represented qualifies and source lenders, and I'm happy to be here.
Well, great. So thanks so much for joining us. So I hosted this panel in this December meeting as well, and a lot of the discussion, as you'd imagine, was focused on some legal challenges and issues facing new markets projects and qualifies and CDEs and investors because of the COVID-19 pandemic. And we thought it would be helpful to get a check-in and figure out what specific issues qualifies and new markets projects are continuing to face, if any, because of COVID-19 as we begin to come out of the pandemic. So I'll just start with you, Carol. Are you noticing in your deals and projects any instances in which qualifies are still seeking any kind of relief from CDEs or investors?
I am. As a matter of fact, just today I sent out a notice of default. Of course, we're working with the qualifier on modifying the loan documents, and I think everything's going to turn out fine. But there are a lot of questions, and I know through this panel we're going to talk a bit about modifications and things that you should be concerned about as the CDE and the investor. So yes, we're still seeing them, not to the same extent. I mean, obviously at the beginning of the pandemic, it was a weekly call, and unfortunately, some of the modifications were made. And I'll talk about that when I talk about modifications, where maybe a few steps might have been missed and just things to watch out for.
How about you, Jennifer? Have you been seeing any issues continuing because of COVID-19 with your new markets project?
We saw a lot of requests at the beginning of the pandemic, but we really haven't seen many as of late. And I don't know if with the PPP loans running out, we'll begin to see a few more. I don't know if that's why we haven't seen many lately, or if maybe the deferment periods were long enough that they still haven't burned off. But we did see a lot early on.
Okay. Well, Carol, why don't we dive into what you raised? We spoke about this. This came up a little bit on the last panel, or I should say back in December on the last legal panel, but could you get into a little bit of the technical discussion behind what's involved in a modification of debt on a new markets project?
Yeah, no, happy to. So, there's really, I think, three main considerations for an investor in a CDE, and in particular the CDE, because they're probably the first contact. And, the first consideration is whether or not you have a substantial modification. And unfortunately, if you have a substantial modification, it's treated as if the original QUILICI was repaid and a new QUILICI was issued. So I'll talk about that in a minute. The second consideration is the CDE operating agreements, as a general rule, require investors' consent. And I know CDEs often become close to their qualifies, they want to help them out, and they forget that there's the investor, and they'll be violating their operating agreement if they help out the CDE without investors' consent. And then the third is the considerations that everyone has to think about with respect to, for example, if you're going to defer a payment or two. In new markets, we have limitations on operating income distributions, or E&P if it's a corporate one. And so those items and how they have an impact, not only at the CDE level, but going up the chain and the leverage lender or maybe a source lender. So with respect to a modification, it's really just any modification at all could result in a reissuance. And, as I said, a reissuance, it's essentially a new COLICI. So if you do end up in the situation where you have a reissuance, which could be triggered from everything from, a change in yield, and a change in yield can occur when if you change interest rates, but it also can occur if you defer payments. So deferral of payments can cause a reissuance. Obviously, changing the dollar amount of the COLICI could have reissuance considerations, as well as if you change the guarantor, if you change the security, if you change your priority. So, sometimes reissuance, not even, through the pandemic or anything, there were other lenders coming in. So all of those items require consideration. And if you do have a reissuance, repayment of the old COLICI, issuance of a new COLICI, it's essentially new opinion time and qualic B COLICI opinions, which generally involve some costs because there's projections and you have to run a new geocoder. We did have a situation where it wasn't in a reissuance, it was another type of workout, but the census tracts had actually changed. So as much as everyone wanted to help the qualic B out, the debt instrument was changing too much. It was causing a reissuance and it would no longer be a COLICI. So, pretty serious consequences. So, to think about. So that's if you have a reissuance. If you don't have a reissuance, in other words, your modification doesn't rise to the level that it's treated as a new debt instrument. It's a very technical tax analysis and has to do with whether the debt instrument's recourse, non-recourse, sometimes whether there's a change in payment expectations, sometimes not. And so when you're changing those items, it's sort of step by step, you need to do the analysis. But if you don't, oftentimes, well, it's sort of split. Sometimes investors and CDEs want what we call a no reissuance opinion, and other times they're comfortable because everyone's counsel has looked at it, the tax attorneys have talked and said, look, this is really clearly, within the four corners of a no reissuance. Even though we've modified something, it hasn't risen to the level that the tax law would say it's a reissuance. And so if you do have to give a no reissuance opinion, that's a much less expensive opinion because you generally don't need new projections, you don't need a new geocoder, you don't, it's just less. So go ahead. Did someone want to jump in or? Oh, I thought.
Well, actually, on that point, I will jump in, actually. So,
okay.
Because as you're speaking, it's making me think that, the qualic Bs are in a tough spot economically, presumably are in a tough spot economically for the project, going through financial hardship to get to the point where they're seeking some sort of debt modification or other relief on the COLICI payments. And given the implications, and as you outlined very well, how serious that can be and expensive it can be because of so many parties having to be involved. To the point about the opinion of no modification or no material modification opinion, would you recommend any strategy or key points to the market's participants as they're going into thinking what are their options up front to think about how to structure a modification that would be relatively safely in those bounds so that they can kind of get a handle on their, the costs going into, any negotiations with the CDE and the investor?
Yeah, we actually do have a lot of conversations, and the one that I'm working on now, it's a carryover from the pandemic. It's just happens to have a lot of different credits involved, and so it's very sticky and complicated. And so we actually did have to back up the modifications that we were willing to make so that we could keep it at a no reissuance. And so, it's obviously a numbers game. And you have to look at each one of the reissuances because, if you're not changing the yield or you're changing the yield, but it's not too much, or, like I said, something else can trigger one of the other ones. So I do think it's really important to make sure that someone is looking at it, probably a tax attorney, and giving some advice. And like I said, we did back up so that you're just up against a certain payment deferral. And then it trickles up too. So, it affects the leverage lender if it's if they're related to the Qualic B. Obviously, there's going to be a default on the leverage loan because money's not going to be coming up. And you're subject to certain limitations in following years. Let's say they catch up on their deferred payments. Well, now the subsidy has a lot of cash, but we have these operating and E&P limitations. So unfortunately, the cash gets trapped at the Qualic B till the end of the compliance period. And so, you have to modify the leverage loan often. And if it's a third-party lender, there's consequences there. The investor is always concerned. No one wants a defaulted loan. So, all the way up and down, there's considerations on that. And, sometimes people keep the loans going. That's very rare at the leverage lender level. I mean, it's been known to happen.
You said, Carol, that it gets trapped at the Qualic B level. What were you thinking there? Were you at the CDE level?
I did. Thank you. Yes, the CDE level. I'm sorry. The other thing is that we noticed too is that sometimes you want to add more reserves, and so there's just all the anytime you're modifying, you just have to think of everything. But it's at the CDE level, not the Qualic B level.
Well, and speaking of the deferments, that's really been the primary issue that we've seen in talking to our CDE clients. If their tax is a partnership, then that's sort of sometimes colored how far they were comfortable deferring out, whether they wanted to just stay within the same taxable year, or if they'd go ahead and extend it out past, the current taxable year, knowing that as of right now, at least with that safe harbor, that money's going to get trapped if and when it's paid, which I think all of us in the industry would like to see some relief there.
Well, speaking of relief, so as we know, the CDFI fund did offer some relief in 2020 because of COVID-19. Examples with reimbursement to prior costs or extension of time for CDEs to meet certain allocation agreement requirements. Have either of you seen any of those specific items of relief or others come into play? And were there any other legal ramifications that needed to be thought through? I could start with you, Jennifer, if you hadn't had any example.
Yes, I have seen a number of deals take advantage of the additional look back period. And then I've had some clients that were definitely benefited by the extensions in the timeline for hitting the benchmarks in their allocation agreement. And it allowed them to go ahead and hit those benchmarks in quality projects. So I don't know if, Carol, you have seen anything similar or different?
Yeah, I've mostly seen the look back, which has been very helpful. And I think part of the look back has also attributed to the same Qualic B receiving maybe another second allocation because the CDEs needed to get it out. So it was kind of an interesting phenomenon that, allowing to look back more, then there was more money thrown at that Qualic B, which helped the CDE get their money out.
So I know that also during the pandemic's worst period, a number of jurisdictions have put moratoriums or imposed moratoriums on foreclosures or evictions of tenants. It looks like many jurisdictions are beginning to lift those moratoriums. Have either of you seen that impact current new market projects, or are new market projects a little more immune from those issues?
Well, I definitely think it's interesting that the moratoriums are expiring this month, and I don't know what consequence of that's going to be on the economy in general or new markets in particular. But they're specific to residential. I think that the commercial side's also been experiencing similar relief through PPP loans and through lenders who are comfortable giving them grace periods while we're in the pandemic. I don't think that I have personally seen any legal implications yet on any of those matters yet. I know that the 80-20 test is something that in a current deal we're looking at on the commercial side, but that's about it for now for me.
Yeah, and similarly, but for the 80-20 issue, which has been of a concern, That's the only extent that I've seen it.
80-20 being 20% commercial income, 80% residential income.
Correct. Thank you.
Well, then I, also like to start thinking about looking forward as we're coming out of the pandemic, of course. Are there any other current legal issues that either of you are thinking will be affecting projects on a going forward basis? Well, specifically, one thing we're thinking about is, is the current climate, whether it's impacted by COVID or otherwise, is it going to have an impact, you think, on the asset classes, the types of projects that might be actually more challenging to finance with new market tax credits on a going forward basis? I'll ask you, Jennifer, if you want to jump in first.
Well, it looked like Carol had a thought.
Okay.
But I do think that from everything I'm hearing, it sounds like the needs are largely in the service industry as we're coming out of COVID. That's kind of what it looks like to me. And I do think that those may be more challenging transactions for people to close in terms of focusing on true debt while still wanting to keep the flexible products there and maybe finance some companies that aren't are thinly capitalized.
Yeah, I was going to say, I don't really necessarily have much to add to that. I don't know that I've seen that impact, but also, I think a lot of transactions are in the pipeline and we're waiting for new allocations. So I guess at this point, I don't really have anything to add on that. I mean, we are seeing differences in the way transactions are done. And, one is, which we all talked about, is Docusign. I mean, I don't think we're ever going to go back to not having Docusign. And, I think that's really helped tremendously with the closings during the pandemic.
I had a practical question on that myself. As we've seen more and more Docusign and just no real ink being used at all on original promissory notes or guarantees or things of that nature, do we expect that will be accepted sort of universally in courts if folks have to go and get cognitive judgments or otherwise enforce their rights under their promissory notes or mortgages, et cetera?
Well, we actually have been for recorded documents and notes requiring original signatures even during the pandemic. I don't know if Jennifer, if you had, but we did not use Docusign for those two documents.
So I think that's been the practice I've seen too, that some banks are requiring originals of the signatures or the promissory notes rather, and it's been the practice that portable documents have been signed as originals as well. Although to your question, Andy, I think that the industry probably is going to find more comfort in that with the Electronic Signatures Act for federal law, and then each state enacting something very similar, where courts are required to uphold these electronic signatures the same as though they're original wet ink signatures.
Yeah, and actually one thing that just popped in my head about sort of during the pandemic, and maybe, I don't know if it's asset classes, but I think it's more census tracts. I was talking to a consultant actually yesterday, and they said that during the pandemic, they noticed that rural placement was very difficult because the investors were more focused on CRA with respect to their investments because they didn't have as big of a appetite for the credits. But now, and credits historically, I guess, have had equal pool for investors. And I'm sure someone on the investor panel could definitely address that better. This is just what I've heard. And so, prior to the pandemic, rurals were a little easier. After the pandemic or during the pandemic, that rural is generally not in someone's CRA service area. I understand it's a more populated area. And so hopefully we're going to go back and see more rural, I guess, which, everyone put in their application. So, I think, well, I shouldn't say everyone, but that, that was one of the extra points for rural. So.
Well, certainly many CDEs do commit to a certain percentage of any allocation they win being applied to projects in non-metro counties, I think is the definition. yeah, I'm certain we'll see it. And it's always more challenging. And we've heard on prior panels, why it's just more challenging generally to find projects of scale in non-metro areas. And but it's obviously an incredibly important policy point, which is why CDs do commit to make that investment. What about collateral? Do you think there's any trends in the types of collateral that'll be taken going forward to secure CLICs? Traditionally we'll take, the typical mortgage on property and security interest in business assets. But are you seeing any trends or any indications that might change?
I've been seeing trends pre-pandemic, and it could just be my client base as well. But it does seem like unsecured, second position, really taking advantage of that for two reasons: flexible rates and terms. And I think that, as a general rule, that's more advantageous to the qualities, and consultants are, quick to point out that CDEs will often take a second position. And then, that creates some challenges. And, especially if you go unsecured, then you're typically looking at something that we didn't have years ago: financial covenants, negative covenants, which I think, we've typically had, but negative covenants about pledging your assets, taking on additional debt. And then, to take it one step further, it seems like, and what I'm seeing is a lot of entities that have a lot of organizations, and they do cash sweeps. And so when you're trying to figure out what these coverages are and how to do that, it gets a little complicated to get that debt opinion. And so that's what we've been seeing a lot of, and I don't think it's going to stop. I think we've moved that direction.
I would agree. And I think Carol described it perfectly. We are definitely seeing a lot more deals that are not secured by real estate, or if they are, then they're subordinate positions, but more and more that just aren't secured by real estate, maybe personal assets, bank accounts, but less and less real estate.
And then the other thing is, when you're in second position, some of the things to think about is that if there's a default on the CLICI loans, but not a default on the senior loan, historically, second position lenders didn't really have an opportunity to do much about that. And some of our defaults, of course, could go to new market tax credit covenants that you can't ignore. And then also, if there's defaults, kind of to circle back what we were talking about at the very beginning, is there's there's modification rules. And it's kind of a rule of thumb. I'll tell you, it's more complicated from a tax analysis, but generally, if you have a default and you just sort of sit on your thumbs for a couple of years, at some point the IRS says, hey, you're not serious, it's not debt, so you have a reissuance. And so those are challenges that, I think as an industry we've been successful in overcoming, but they are sticky negotiations with a true third-party lender who says, hey, you're in second position, I'm not going to default my loan, if your loan defaults and mine doesn't. So we typically give them a certain, say, okay, well, we can sit for a little while, but at some point there has to be a cross default. And then with the new market tax credit covenants, we try to get specific performance obligations in there so that they are playing along with us. But that can be really challenging when you're in second position.
Yeah, I was going to say, so then really the hard work is the focus of becomes the focus of either the subordination agreement or intercredit agreement. However, it's drafted between the CDE junior lender, then in that case, and the direct senior lender. And I know personally, oftentimes the first draft of that intercredit agreement you get from the senior lender is as deep of a subordination and as big of a standstill as you could possibly imagine off the shelf of their standard form. And trying to chip away at that can be challenging. And not all CDEs, I don't think, are going to come in when CDEs want to come in second position, as you said, because of the flexible rates and terms, it's a good thing, right? That the CDE is trying to provide additional flexibility for the Kalicki product to the Qualic B. But you're right. Then there's that countervailing premise that you can't just stand by and not act like a lender. And there's a certain period of time. And I think we've talked in other panels, or maybe that some people get comfortable with about a 2-year sort of waiting period before you have to act. But you mentioned the ability to call default, but really, to me, it's even not just the ability to call default, but also then to take action, right? Whether it's foreclosure or other remedial action. And I know that, at least personally, most of the intercredit agreements, subordination agreements I see on initial draft, it's it's forever standby, right? You can't do anything forever, so having sense of that up front is definitely, to me, would be a really important thing. If you're going to be a CE wanting to offer a subordinate mortgage up front, you better be ready to negotiate that point or have that discussion with the senior lender early on.
Yeah, and just so to be clear, it is not a 2-year rule. So please, no one think that
not
you
a
can
rule.
sit back.
It's a sensibility as much as anything, right?
You know.
Yeah, definitely. It's not written there, which is why we don't know. And some people get comfortable with that. Some people are comfortable with not that much. So case by case basis for sure. I think maybe one of the other things thought maybe we would raise, are there any federal or state legal requirements, this could be going forward or currently, that you think could pose, challenges to NMTC projects compliance with CDFI rules and regulations?
Sure. Well, I mean, I think the one thing that sometimes is surprising, and probably not to investors in CDEs, but to Qualic Bs, is we're trying to harness three different types of rules. There's tension between the rules. There's the CDFI fund rules that the allocation agreement controls. And sometimes the investor and CDE are aligned in those. Sometimes they're not, because they're only allocation rules. And so, the investor isn't subject to that. And, one example, but of course, I mean, everyone works cooperatively, is your allocation agreement. Everyone knows a lot of people have a 98% sub-all, where for tax, code purposes, the investor's purposes, it's 85. Then you have the federal tax law, which, I just said some of the differences there. And then you have state law. And so to the extent what we have found is if you just focus on one, you might lose sight of the other and have some issues. And something that comes up pretty common in at least the deals I work from, and remember I was talking about larger entities that have a lot of subs that sweep cash. And all of a sudden we have an unsecured loan and we're trying to come up with financial covenants and cash is being swept. And oh, by the way, for state law purposes, the Qualic B is a single member LLC. So for state law purposes, that is a legal entity. And if you sue, unless you're piercing some corporate veil or something, you can only go after the assets of that entity. And so, but for new market tax credits or for federal income tax purposes, the entity with its sole member, that's the entity we're looking at. And we have, a POB situation. And so what happens is when you have these cash sweeps, the question is, who owns that money? And if it's swept in such a way that it's really a distribution to the sole member, you as the lender would no longer have access to that cash. And so your financial, it's just very difficult to draft documents, much less if you ever were to foreclose. And so that's just one of the things between the different rules. And I'm sure for years, I think we've all understood and looked at and analyzed the difference between the CDFI fund and the IRS rules. And I think some of them have come closer together. But, another way that there's a divergence in the affordable housing. And we found when we put together combined new market tax credits and historic tax credits the investor wants a really strong SNDA on the master lease. And of course, the investor, you never would recapture new market tax credits if you didn't meet the affordability requirements. So the investors, have reasons why maybe they're not, they don't want to crater their deal and lose their credits if you below the affordable housing. However, the CDE, that's in their allocation agreement. So there are things that you just have to, for federal purposes, that's a meaningless, for 45D purposes, that's a meaningless requirement, but for the CDFI fund, that's a very real requirement.
So can we go back and revisit that cash sweep concept? That's fascinating to me. When I think of
I can't hear you, Andy.
Can you hear me now? Sorry, I think I hit my mute. Sorry about that. But the cash sweeps concept, we could pause on that for a second. That's fascinating to me because, we spend a lot of time thinking about operating accounts and cash accounts and how do we get security over that. And, there's these standard typical bank pledge and then a separate control agreement that you typically get from the bank as a standard form. And the control agreement is what provides perfection, right, of the pledge. And as I've read them and drafted them before, it's, basically it wouldn't allow for a sweep because you couldn't sweep cash without the consent of the CDE in each instance anyway. So if there's these sweeps happening, are you seeing them still with these same kind of control agreements and pledge agreements in place? Do they carve out that? Do they allow for that?
Yeah, so typically, I think we know in new markets, oftentimes CDEs reserve their fees and have a pledge agreement. So that cash is off limits, even to whether you're a subordinate lender, in your intercreditor agreement, of course, you carve out those accounts. In cash sweeps, you say you can't sweep that cash. So for all the reasons you said, you're exactly correct that cash is not part of any cash sweep. It actually can be, it's interesting because these qualifies, they have always swept and that's how they've kept it. And so now you have to say, no, you can't sweep those particular aspects. So it doesn't necessarily go to, will the CDE be paid their fees? It really goes to more of a debt question. If you had, do you have any type of rights, even if you don't have a security interest in it as a general creditor, normally you would be able to go after that cash. And we, it's more complicated. We could talk about some other legal reasons why maybe they can't sweep or you can claw back the cash. But as a general rule, yes, you're correct that the pledged accounts are not swept. And sometimes we require them to have, and they have their own bank account. Sometimes we might put a pledge on that and require some minimum cash that they need to keep there in addition, those type of items.
That's all the questions I have for our panel. I think we have time to take some questions if we receive any. Bridget, I don't know if you are managing that.
I guess one thing that we kind of glossed over that I really would be curious to get maybe more thoughts from you and Carol on is just the concept of additional indebtedness. I know, I think we're going like way back to earlier in the conversation just about documenting that I see more and more people, qualifies, asking to have carve-outs on the prohibition against additional indebtedness to permit very specific amounts of debt and sort of the parameters of that. And then at the time we're closing, we're all getting comfortable with them taking on that additional debt in the future. But I'm seeing, and I don't know, Carol, if you're seeing it too, but I'm seeing many, many requests coming through where our qualifies are asking for consent to take on additional indebtedness. And then unfortunately, the whole, in many cases, as Carol mentioned, having to go through the whole analysis of whether or not that's a significant modification, leading to a reissuance, and then unfortunately, just the qualifies incurring a whole bunch more expense in order to get additional financing. And just kind of curious to get others' thoughts on that.
Yeah, I mean, there is some relief in reissuance if something's in an original document and it just happens by operation. So sometimes you can slip in under that. Other times, there's certain consents that sort of mess up and you actually do have a reissuance. But I agree with you. That is something that really is a trend, and I don't think it's going to stop, is that these companies want, and the CDEs, as a general rule, and investors, they don't want to stand in the way of, Qualic B's expanding. So the interesting thing about trying to draft those provisions is that it might take a lot of time, energy, and money to draft those provisions, and you end up with a soft consent because you just never know what the future holds. So, I mean, it's kind of a catch-22. Do we spend, hours and hours negotiating exactly what does that look like? What do you have to, do to take out that debt? Or do we just wait and do it at that time and, have some reasonable consent and some understanding?
And I guess another option, which is a harder one, is whether or not we can ever get to a place where maybe we would have guidance to let us know that, in these instances where qualities are coming to us and asking for additional indebtedness, CDEs are not going to lose their reasonable expectations. It's not going to be a reissuance under certain parameters, which I just think as an industry, we would all be in favor of.
No,
I guess
go ahead.
I was going to say, I guess one of the ways I think about it is, everyone in the deal team when you're going towards closing, the group is underwriting projections, right? That the amount of indebtedness currently in place or being contemplated at the time of closing, is sized to a point that based on the projections of the revenues, right, whatever the project's going to be doing, that it can service that debt. And that's one of the factors, I believe, to making that true debt determination at that time. And so, which is, I think, one reason why we typically put in, you can't, prohibitions against taking on additional indebtedness. It's not because we don't want the Qualic B to grow. It's because for that very reason, if Qualic B then were just to go out and take on, additional huge amount of debts, that would essentially, I guess, water down their ability to pay the original Calicki notes. Then does that mean the Calicki notes are no longer, able to be paid? And does that affect the true debt analysis at that time? I guess that's one way I've always thought about it. So do you think it's possible, and maybe it is, to sort of stress test that in advance, through the modeling, so that you can give sort of a collar, if you will, to the Qualic B and build that into the document, say, no additional indebtedness over a certain type or over a certain amount even.
Yeah, I mean, clearly that's one way to approach it, and stress tests are great. And we use stress tests in a lot of situations. We've had situations where a Qualic B, for example, only had a shorter lease. So you knew they were going to have to move, during the period. So we built into, the term of the loan, we built into our projections the cost of moving and an analysis. So, I mean, I think you're exactly right. I think if you are anticipating debt, your projection should certainly show that if it were to, and you're writing it into the documents, that you could service all debt. And I think they're typically tied to, meeting certain debt service coverage ratios and other type of financial covenants.
Right.
Well, and I guess another thing that we kind of glossed over that I really think is worth emphasizing is towards the beginning when we were talking about all these deferments that we have been seeing, Qualic B's requesting, and how, Carol walked us through, very beautifully how there's the risk of redemption there. And that it's just interesting that whether in this particular situation, if you're a CDE tax as a corporation or a CDE tax as a partnership, makes a really big difference. And I don't know that that is something that the program really thought about as being intentional, and that it would be nice if, partnerships were also allowed to distribute out up to earnings and profits rather than being capped at operating income.
Yeah, I mean, it's interesting because a couple of years ago, we received some guide. Oh gosh, now probably, I don't know, maybe 5-7 years ago. And then it just sort of dropped. But I agree. I think it's really something that we need some relief on. And I think it'd be equitable. And I don't think it should matter if you're doing it in a corporate or in a partnership entity. So I 100% agree with you.